Hello and welcome to this market and economic update. In this video, we look at why gasoline and diesel prices have been climbing, what is behind the increase, and what it can mean for everyday spending, inflation, and the broader economy. For most people, the price of gas is one of the most visible ways that world events show up in daily life. With tensions in the Middle East pushing oil prices higher, this subject is front of mind for many households right now. For some, this may bring back memories of 2022 when prices at the pump surged. Others may even think back to the energy crises of the 1970s. That said, it is worth pointing out that the current situation is meaningfully different from those earlier episodes. Over the next few minutes, we will cover what is happening with gas prices, how to think about them in context, and what higher energy costs could mean for inflation and the wider economy. Let us start by looking at where gas prices are right now. The national average for regular gasoline has risen to around $4 per gallon, which is more than a dollar higher than just 1 month ago. Keep in mind that this is a national average. Depending on where you live, prices at your local station may be noticeably higher. While prices are still below the all-time high of $5 per gallon reached in 2022, the increase is significant and many families are already feeling the pinch. To make this more concrete, consider a simple calculation. If a typical fill-up uses about 15 gallons, an extra dollar per gallon means spending $15 more each time you visit the pump. For someone who fills up once a week, that adds up to roughly $780, less available over the course of a year. For those earning lower incomes, each fill-up could cost the equivalent of about 2 hours of wages. For the average household, the added expense is manageable, but it does leave less money available for other spending or saving. The effects do not stop at the gas station either. Since fuel is used to move and deliver almost everything we buy, higher transportation costs tend to work their way into the prices of goods and services across the economy. In this way, rising gas and diesel prices can act as a broad drag on what people are able to spend. It helps to understand what goes into the price you see at the pump. According to the U.S. Energy Information Agency, roughly half of the price reflects the cost of crude oil, which is the raw material that gasoline is made from. The remainder covers the cost of refining the crude oil into gasoline, as well as transportation, distribution, and federal and state taxes. This explains why prices can vary so much from one state or city to another. It also explains why gas prices do not move in perfect step with oil prices. There are several stages between the oil market and your local station, and it takes time for prices to change to flow through each one. One noteworthy signal from the market is that oil futures are currently showing what is called backwardation. This simply means that oil is trading at a higher price today than traders expect it to be in the future. In plain terms, the market appears to view the current price spike as a short-term disruption rather than a lasting change. This is not a guarantee that prices will fall quickly, but it does offer some insight into how market participants are reading the situation. Finally, higher energy prices have an impact on inflation, which in turn affects decisions made by the Federal Reserve, the central bank that sets interest rates in the United States. Energy costs make up an important part of what is known as the headline consumer price index, which is one of the main ways inflation is measured. After several years of improving inflation numbers, the recent rise in oil and gas prices is likely to push headline inflation higher in the months ahead. This matters for everyday investors because rising inflation can create challenges for both stocks and bonds. It also makes things more complicated for the Federal Reserve. Markets have already begun adjusting expectations, with traders now seeing a greater chance that the Fed keeps rates where they are or even raises them rather than cutting. Historically, economists have tended to view energy-driven inflation spikes like this one as temporary, since prices usually come back down once supply problems ease. It is also worth noting that the United States is now the world's largest oil producer, which gives the economy more stability than it had during the past energy crisis, like those in the 1970s. For investors, the most reliable approach continues to be staying invested with a well-diversified portfolio and a clear long-term financial plan. We hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.